Hello everyone, welcome to the fresh edition of Commodity Weekly Audiocast with me, your host and guide Ravindra Rao from Kotak Securities Commodity Research Desk. As always, we will understand what moved the commodity markets last week and what's in store for the current week. It was a data-driven volatile week that witnessed swings in US dollar index and precious metals. The dollar index that traded as high as 103.50 fell on Friday last week and closed the week flat, gaining by just 0.05%. Resilient economic data from US have defied fears of a recession, though it added more room for the Fed to continue with rate hikes. This pushed 2-year Treasury yields to 3-month highs of 4.93%, resulting in a yield conversion of more than 1% between 2-year and 10-year Treasury yields. US GDP growth for the first quarter was revised sharply higher to 2% from 1.3%. Initial jobless claims unexpectedly dropped last week, while consumer confidence hit a nearly 1.5-year high in June. Moreover, results from Fed's annual stress tests showed the 23 biggest banks in the US are well positioned to weather a severe recession. However, the Fed's preferred inflation gauge rose 0.3% month on month, in line with forecast and below 0.4% in April. Also, the annual core rate slowed to 4.6%, and the headline PCE rate reached the lowest in nearly 2 years. This pressured dollar as the bets of a July rate hike by Fed eased a bit. Also, the odds for another quarter point hike in September eased to 21% probability from a 25% probability. It will be interesting week ahead as it will include the US Nonfarm Payrolls data, FOMC Minutes, US Manufacturing and Services PMIs, as well as the RBA rate decision. All these events might influence dollar's move, which can be quite volatile. On the price action front, we still believe 103.60 to 103.70 zone would act as a good resistance as it is the falling trend resistance line. On the flip side, support is pegged near 102.60, which is the 60-day MA support. Break on either side might decide a direction. Till then, the said range of 102.60 to 103.60 would continue. On commodity specific, COMEX Gold witnessed a good recovery on Friday after hitting a low near $1,900 an ounce on Thursday. The rebound was seen as dollar slipped below 103 after course PCE report from the US. However, gold still witnessed its first quarterly decline in 3 as rising treasury yields amid hawkish remarks from major central bankers weighed on non-interest yielding bullion. As compared to gold, silver has shown some resilience as the recent fall was overdone. The white metal gained by around 1% on Friday, whereas on a weekly basis it was up by close to 3%. The week would be very important for precious metals as the focus will be on US non-farm payrolls print, FOMC minutes, US manufacturing and services PMIs. Data print indicating strength in the US economy might push the dollar, pulling the precious metal lower and vice versa. Technically, if you look at COMEX Gold, it has taken good support close to $1,900 with the as a pin bar has been formed and a bullish candle was formed on Friday. However, the bulls will have to take $1,936, $1,940 zone on a closing basis. If they take that out, then we might see some kind of a bounce back in gold prices. Otherwise, we expect gold prices to stay between $1,900 to $1,936 on the higher side. In case of silver has formed. There are two interesting findings in case of silver on charts. One is on the daily chart, it has formed a morning star, which is a bullish candlestick pattern, which is indicating a possible reversal in silver prices. Second, if you look at if we analyze through the harmonic patterns, it is kind of making a 5-0 pattern. It is about to make a 5-0 pattern, and if it completes that, then this might be a reversal point, and silver on the COMEX might move at least close to $26. Now this is a bit of a short-term view, short to medium-term view, but it looks like it might reverse from here on with two major formation. One is the 5-0 pattern and the other is the morning star. And on the lower side, the Morningstar low is close to 22.14. So if it goes below that, the pattern might negate. Otherwise, it seems like we might see some kind of a reversal action in silver prices going ahead. On the energies front, oil prices have been wavering as supply tightness concerns countered rate hike fears. Still, oil prices closed the week with 2% upside and closed the month with a 3% gain, owing to some support from a substantially higher 9.6 million barrel draw in US inventories and a surprisingly positive US GDP report. OPEC meeting will be watched this week by oil market participants, while Saudi's production cuts of 1 million barrel per day started from July 1st, and the rest of the OPEC producers extending their cuts through the end of 2024, in line with a broader OPEC Plus agreement to limit supply until 2024, might be supportive for crude prices. On the technical front, crude is still it is still consolidating in that range of $74 to $67 in case of WTI, and we expect this to continue unless this range is penetrated. So it is expected to trade in that very range. In case of MCX, the range would be 5,550 on the lower side, and on the higher side it will be close to 6,100 levels. So we expect this range to continue unless the range is broken and unless there is any major trigger in the fundamentals. Natural gas prices have been strong since past few sessions. It has penetrated a triple top resistance near 222, and it has given a close above that, which is indicating further strength. So 220 to 220 would now become the support, which might attract buying. And on the lower side, strong support is close to 208, 206, below which the pattern, the breakout might negate. And if it holds above this, we might see prices going higher to the next resistance level of 246. Finally, base metals extended declines last week and slipped to fresh monthly lows, as most central banks clearly prioritize inflation control even at the expense of economic growth, threatening demand prospects. Also, double-digit decline in industrial profits and continued contraction in factory activity highlight soft demand and ongoing factory gate deflation in China. However, it also boosts call for further stimulus from China, especially after optimistic comments by its premier regarding growth and effective measures to expand domestic demand in the World Economic Forum's annual meeting earlier in the previous week. On the price action front, zinc would still continue to be the preferred bet on back of a bullish engulfing formation on weekly charts, and we expect prices might be supported until 204, which is the pattern low, holds. And the immediate support is near 216. Above that, we might see prices going higher again towards 218 or 220 odd levels. Copper also has formed a bullish pattern. It is kind of a morning star, but the confirmation will come only above 719 close. So if it closes above 719, we might see prices again moving higher, and it might target 736, which is the next resistance. So more volatility is expected in the week, considering the Fed's economic data dependent timing of any further rate hike decisions, with several important indicators lined up. To mention, as mentioned, final manufacturing PMI, FOMC meeting minutes, and most importantly, labor report will be cautiously awaited, as any easing in jobs market may lead to repricing of rate hike expectations by the Fed. Well, that's all from this edition. Thank you for tuning in. Any suggestions, questions, or ideas for future episodes are welcomed. Feel free to reach out us through your advisor or connect through our social media handles. All the best. Trade safe.